Hi, everybody, and thank you very much for joining us for this chat with Dr. Soumya Ghosh. He's the Group Chief Economic Advisor at SBI. And just to give a brief context as to why we are having this chat. So, we have seen the last 2, 3 years have been quite challenging for all of us. But we have come to a point now where perhaps we can look into the future and see that there could be some sort of normalization ahead for us. It's no longer out of context to think that we can reach that level of normalization. We have recently seen the Reserve Bank's monetary policy as well, which has come through. There has been a 35 basis point hike along expected lines, though the stance still remains withdrawal of accommodation, which means they're still in hiking mode. But they seem quite confident now, regards to growth and even battling inflation. So we're going to ask Dr. Ghosh to put all of this into perspective for us to try and fit all the pieces of the puzzle and also tell us what we can expect going forward in 2023. So, Dr. Ghosh, thank you very, very much for your time in what has been a very busy week for you as well. I want to first start off by asking about the policy itself, right? You had expected a 35 basis point rate hike. We got exactly that. You expected that any change in stance right now would be too confusing for the market, and it looks like the MPC agreed with you. So, what is the view from here on? Where are things headed? How long will the Reserve Bank, or the MPC, I should say, remain in hiking mode?
Yeah, good morning, and thank you, Soumya, for this opportunity. I think I will start with the statement which basically sums the current scenario. The only thing certain in the current scenario is uncertainty. So basically everything is certain, but the uncertainty is basically everything else is uncertainty is the only certain thing in the current context, and this is amply demonstrated by the RBI policy statement. I actually, if you want to ask me about the policy statement, I would like to make one statement. It's a dovish for hockey statement without getting into the debate of dovish, hawkish, we are owls, like that statement with Dr. Patel had made the earlier RBI governor. So I would say it's a dovish for hockey statement. Why it's a dovish policy? Because the RBI has actually said that the days of 50 basis point rate hikes are over. So we are getting into 35 basis points. And why it is hawkish? Because there has been some interpretations in the market, although I don't fully agree with them, is that the RBI could actually the inflation fight is still on, it still rages on. So and Dr. Patra, the deputy governor, has said that the real rate of interest is actually 85 basis points now. So that, and there was also a statement where if we had pointed out there was a confusion between is and was. So I think paragraph 7 of the policy, paragraph 15 and paragraph 30, these two statements actually sums up the mood of the RBI. In paragraph 7, the RBI says was of the view. So the market has interpreted it saying that was is basically for future is. But I think that was only for the discussion of the MPC deliberations last week. And in paragraph 15 and 30, the RBI has clearly said that it will wait for future rate actions, the impact to unfold. And here I want to put you in one interesting point. Why I am calling that the statements are hawkish, but possibly this policy is dovish, is that if you remember, just a fortnight back, RBI in his monthly bulletin had projected that the GDP growth rate for the current year, India is on course for a 7% growth this fiscal. And after a fortnight back, the Reserve Bank of India has scaled down the projection to 6.8%. Now, fast forward and juxtapose this with the fact that monetary policy has long and variable lags. So given the fact that we started hiking in the month of May, assuming that 40 basis point policy normalization, I'm not taking that into account, and then you continue the 225 basis points, any policy lags is basically 6 to 9 months impact. So by that logic, if April is the starting point, I think the fourth quarter of the current fiscal will start seeing the impact of this policy hike on possibly inflation is supposed to come down, also maybe some impact on the growth momentum. So taking that factor into consideration, the RBI has very judiciously lowered the GDP forecast to 6.8%, and that is because of a weaker second quarter. And this gives us the view that if you ask me if I want to, end with an famous Hindi song that koi pe nigahe, koi pe ishara. So that is basically the sums of the monetary policy statement.
Yes, in fact, I read your editorial as well this morning on growth, and for second quarter itself, you had expected, I think, 5.8%, right? It came in at 6.3. Now we have seen that the MPC itself has scaled down the target, like you mentioned, to below 6.8%. Do you think 6.8% is achievable as well? And you in your editorial, you write about how there's a structural shift that we are seeing in terms of growth. You have sort of seen the similarity with the World Cup that is going on. So can you explain what exactly we can expect on the growth front?
Yeah, I think all of us, at least that is also keeping ourselves busy in the night for the last month, because the World Cup is on and there has been some stunning results. So in terms of, I think we can see that the divide between the European football, the Latin American, the Asian and African is constantly narrowing down. Now exactly, I have taken that initiative to see that Indian economy is also changing. There has been some structural changes. First, to address your question on whether we are going to get an 6.87% growth this year, I still believe that maybe we'll be close to maybe we'll be close to 7%, if not 7%, and maybe we'll be able to a little bit higher than the 6.8%. But the central bank is very cautious, and that's why it is actually preparing ourselves for a market for changing the stance from withdrawal of accommodation to a neutral, which will mean it can go either way. So basically my sense is that yes, it could touch 7%, because in the second year, if you have to grow by 7% for the full year, second year growth is around 4.7%. So maybe that could be a possibility. Now, having said that, I think some of the changes which we have noticed, one changes which I'll highlight over here is that there are two components. Look into the GDP component, and for the simple, in very simple layman terms, one is basically the government expenditure. The other is also an element of government expenditure on it, that is the public administration, defense, and other services. Now, ideally, what should happen is that when the government is spending, both of them should move in unison. And this has happened before the pandemic. But what has happened after the pandemic is that both of these have actually started to move in opposite directions. The public administration, defense, and other services were understood because there's also an element of health education on it. And if you remember, all these schools and services were closed during that period. But the government expenditure part, which also includes a lot of concurrent expenditures on, say, printing, the fuel expenses, office expenses, these has actually started to decline post the pandemic, while the other component is actually increasing. So that means that there is a shift possibly in government expenditure from consumption expenditure to expenditures which are more enhances social capital, for example, health and education. And if this trend is sustained, I think that is good for the economy. May not be in the short term we'll be able to see the changes, but over a longer period of time, this is always good for any country which builds up its social and productive capital. And as all of you know, in fact, just to take this argument a little forward, the RBI, as all of you know, that the government budgeted borrowing this year is as close to 20 lakh crore, the states and the center. But even after that, the yields have actually been stayed significantly anchored. And do you know why? One of the reasons is that the insurance company, there has been some shift in the behavior of the agents, of the people who are buying insurance companies after the pandemic, and they are now actually buying insurance policies, and insurance companies are actually buying G-Secs of longer duration. So if I link this with what I said earlier, the point is that the government is also picking up enhancing social productive capital and along with a change in expenditure by us by people on health, I think that is going to be beneficial for the economy, and this is one of the structural changes which I elucidate in my article.
Understood. In fact, I'm going to come back to you on this point in a little bit. But a word on inflation right now, because that seems to be the biggest challenge, right? So the Reserve Bank has said that their first level of comfort is 6%, and then they want to look at bringing it down lower still, right? Closer to 4.5. Where are things headed in that direction? And in this fight between, promoting growth and battling inflation, where does the comfort zone lie for the market?
See, I think the Reserve Bank communication has been very prudent in this, that they want to guide the market towards the 4%. But I'll just take the example. But I think the Reserve, but I would like to take the example that it is a flexible inflation targeting regime. Flexible means you are targeting inflation throughout the cycle, not at the point of the cycle. So what the central bank is trying to emphasize is that it is trying to focus on inflation and get it down to 4%. But at the current point, it is actually focusing on inflation through the cycle. And we have the examples of Reserve Bank of Australia in front of us, who has been doing this for 25 years, and they have been actually targeting inflation through the cycle and not at the point of cycle. So this is point number one. The second point is that next year, yes, inflation numbers next year is going to come down. The RBI projection is 5.2%. We are also more in sync with that. Some of the numbers could be even lower than 5% in the beginning of the next fiscal year. But regarding 4%, I think that will be a long-run process, because the RBI has clearly said it wants to get break the back of core inflation, and core inflation has been persistently strong in the last 1 year or so. But the important point to note is that service inflation is actually a larger component of core inflation, and given the fact that fuel the taxes continue to be at high level, and there is the possibility, the chances of rationalization of fuel taxes looks a little bit difficult at this point of time. So my sense is that getting to 4% will be a little bit arduous task. I'm not saying it's going to be impossible, but it's going to be a difficult task, at least in the next fiscal year. Maybe over the next 2 years, the Reserve Bank can target it, but may not be in the next fiscal year. It could go to 4%. So it has to be a transition which has to be well thought of.
Okay, understood. But when we talk about macros, the one figure that gets undue attention, at least from all of us non-economists, is the currency, right? The rupee and where it's headed now. I think the point that it's not just rupee weakness, but the dollar strength, which is, what is weighing right now. But given that, given the fact that dollar is likely to continue strengthening well into 2023 as well, what is the outlook on the rupee?
No, I think this is a very important question which you asked. I think there are two parts to this question. The first was basically the random dollar strengthening. Unfortunately, the Ukraine war has actually, before the Ukraine war, there was a consensus that dollar is going to weaken, because the US was actually running a significantly large current account deficit, and notwithstanding the fact that dollar is a reserve currency, there was a consensus. But unfortunately, after the dollar, because of the reserve, after the war, because of the reserve currency agreement, reserve currency argument, the dollar strengthened significantly. Now the question is, now the dollar has again started to weaken, because there are indications that the Fed could actually tone down on the quantum of the policy rate. And Fed has already clearly said that it will not do a 75, but it actually could do a 50. But here also there is another issue which is actually recently, we have been also emphasizing this for significantly, is that the US labor market continues to be extremely strong. And the important point is that after the pandemic, there has been a fundamental shift in the US labor market. There are reports of US government which says that 10 million people in the age group of 25 to 54 category are missing from the labor force because of the pandemic. So that's why what is happening currently is that we have a low unemployment rate, we have a high vacancy rate, because the skilled laborers are in shortage. This is the problem with every economy. India is also included. So if I take that factor into view, that the vacancy rate continues to be higher, there is a missing middle in the US labor force, and the unemployment rate is low. All this conjures of the fact that it will be difficult for the US labor market unemployment rate to go up, which the Fed is trying. Fed is actually trying to slow down the economy. And that's why there is another argument going on, that if it tries too hard, we may actually end up in a recession. So therefore, but if I take that argument into account, or whatever stagflation or recession, whatever may be, there is a possibility that the US dollar could start strengthening again in the future. If that is the case, there will be pressure on the rupee. But I still maintain that the rupee has performed admirably, with crude at more than 100 from February. And with capital flows, there was an outflow of capital flows, was 14.7 billion in the till 29 July. I think the rupee has still, remained comfortable. Much of this could actually go to the Reserve Bank of India in protecting the rupee. But my sense is that there could be pressures on the rupee, but in the short to medium term.
Okay. So do you expect then that foreign flows will continue into India in the coming year?
Yes, basically foreign flows has been continuing. November was very strong, 4.1 billion inflows. And that's another argument which I want to just put in over here. Even though there is a consensus that there could be pressure on the rupee, but if these foreign inflows continue like this, and given that the growth numbers have been quite satisfying for the second quarter, that could act as an offsetting impact on the value of the rupee. So therefore, my sense is that don't think of a significantly weaker rupee. But at the same point of time, even if the rupee sustains at the current level or appreciates a little bit, I think that will be a good message for the market, because the Reserve Bank is also, if you remember, Reserve Bank is also recouping foreign exchange reserves, because for the last 1 month, the total foreign currency reserves have actually increased by at least 25 billion. So a part of this could be devaluation, a part of this also could be RBI purchasing from the market to shore up its reserves. So that could also give a signal to the market that the RBI may, for the time being, allow the rupee. RBI doesn't target a rupee, but the message to the market could be the rupee could be at the current levels, and with some plus minuses. Obviously there could be a two-way movement, but the sense I get is that significant weakness in the value of the currency is not possible at this point of time, though there will be pressure on the value of the rupee, given all these conflicting the parts playing out.
Understood. So just one final question then. Going forward into 2023, what do you think will be the one key macro driver for India and the biggest macro challenge?
I think, as I said to you, the biggest macro driver should be the external sector, the growth prospects in the global growth prospects. They continue to look very uncertain. Europe is actually mired in an energy crisis, and the problem is that US also has been pursuing its manufacturing in America one, and now there is pressures on some of the European. This was pointed on the recent article that some of the European companies are actually now want the policies in Europe to be favorably tailored towards them. So not only an energy crisis, but also there is pressure on the Europe, some of the companies in Europe who actually want also similar amount of benefits. So the global economy and China, as you know, and that is one factor which I just wanted to highlight also. And because of the fact that China is trying to control COVID by just locking down, I think that is not going to help. If you take the example of India, with population of the same kind, India allowed the virus to travel through the travel through a large part of the population. So, and we had a very successful vaccination strategy. But given the fact that China is just trying to lock down, that is not going to work. So my sense is that a large part of the world could, even though there could be a global recession or global slowdown, as whatever we may say, the counterbalancing positive factor is that the China plus one strategy, whereby people now conceive that the days of China's recovery, China's story is over because of the simple fact of the COVID infection. If that is the case, that could actually act as a default factor of driving the foreign flows into India. We have seen that happening from August, and we may actually see that happening. So therefore, there will be two factors. Hopefully, let us hope that the second factor outweighs the first factor, because India has a very strong domestic consumption, which has been very strong in the month of October. November auto numbers today, I understand, has been one of the best ever. So, and if you look into the airports, there are stories that there are significant crowds at airports and other places. So that gives me the hope that possibly the domestic consumption will outweigh the possibility of a slowdown in exports, even though exports this year, last year we did 420 billion of exports and 250 billion of service exports. This year, the first half, we have already done 230 billion of exports and 150 billion of service exports. So maybe this year we could actually cross 670 billion, which we did last year. So if we do that, that will still be an achievement, even after accounting for a slowdown in exports. So let's hope that the domestic consumption counterbalances this. And if that happens, I think the challenges which will much come from the global economy is going to be mitigated by a story of Indian rebound and resilience.
Touche to that, Dr. Ghosh. Thank you very, very much for your time today. And thanks very much for putting all of this in context in a language that we can understand. So thanks once again.
Thank you.